Leg down. I mean, Tim, looking at the market, we're seeing a little bit more interest coming in terms of the banks. Commonwealth Bank was trading below $80. It's now back at around $82, $83. What do you think of the banks?
Yeah, look, and the banks are probably reflective of the market as a whole, particularly given that they account for a large percentage of the market. And the story, as far as we're concerned, is that valuations started to get a little bit stretched earlier in the year. More recently, we've seen share prices come back closer to fair value, which is, from our point of view, good news, because when things are expensive, we're obliged really by valuation to go to cash. When they start to get cheaper, we're able to redeploy that cash. And we would be on the, I guess, the other side of the trade, perhaps, to Nick, if markets did pull back sharply, in that from a value investing point of view, that is when you want to get cash into the market.
So I have to ask you, how much cash do you have at the moment in the fund?
So we are around 24% cash at the moment. We're reviewing the portfolio now, and we may put a bit more of that to work in the market. But we haven't seen a huge swing in value yet. We'd need to see the market go down a lot further before we'd put the bulk of that money back into work.
Technology One. What are your thoughts on Technology One, Tim?
Look, it's a great business. It's one that we've looked at a couple of times in the hope that we could make a valuation stack up for it. We haven't been able to, but well done to the caller on being able to get it at a significantly better price than it now trades at. For us, it's just not worth the price it currently trades at, so we don't own it. Altium is, in our view, better value, and it's actually one that we do own. It's at a level now where it's not as compelling a value case as it was, but certainly, given a choice between the two, our clear preference, given that we own Altium, is that Altium represents better value at this stage.
Weak. So, Tim, looking at On the House.
Yeah, not a stock that I know a lot about. It's capped at $54 million, so it's too small for us to study. What I can say about it is that the share price, over a long stretch of time, it hasn't really done anything. There's been fluctuations up and down, which reflects the fact that it's very hard to accurately gauge the long-term potential, I think, of a business like this. Where it sits now, what I would say is that on the basis of its recent earnings track record, it's not good value. There are broker forecasts that show earnings a couple of years out rising from what looks like $0.3 million in 2015 to $3 million in 2017, so 10 times growth in earnings. I don't know enough to know whether or not that's a reasonable set of forecasts, but I do know that we frequently see broker forecasts that show a business whose profits have gone down, going sharply up some years down the track, and more often than not, when you get a couple of years down the track, that profit growth hasn't eventuated. So I'd be cautious of On the House from a value point of view, given its recent track record.
Okay. What are your thoughts here?
I don't sort of take much from the stock chart, so maybe Nick might be better placed to comment on that. But it does look as though it has done very well since it was floated, which is a good sign. I'm a little bit intrigued. It's got a market cap of around $300 million. It's got no broker coverage, which makes it hard to get much of a sense of its earnings potential. It does, however, look as though it's trading on a really large multiple of certainly the profits it's earned in recent years. It's a really interesting area, cloud-based platform for delivering online services to buildings and their occupants. There will be some businesses of this nature that do well in the years ahead. I don't know enough about Urbanise to be able to comment on its chances of success, but I can say that at the current price, the market is pretty much expecting that it will be a strong success story, when it doesn't yet seem to have demonstrated that track record.
What do you like this? What do you look at when you're trying to evaluate a company like this, Tim?
Well, with technology businesses of this sort, I think a lot of or one of the big differentiators is whether or not they benefit from network effects. So businesses like Seek, real estate, car sales, they benefit from an effect that once they've got the scale on their platform, everyone uses them, and there's a virtuous cycle of advertisers and users, and that's proven to be a sustainable barrier to competition for a lot of these businesses. In the case of Urbanise, it's not a business I know a lot about, but it doesn't seem to me as though it fits into that network effects category. Obviously, when you've got a building on the system, I think it's probably hard for that building to switch, or there's a switching cost that is to their benefit. But the fact that some other building down the road is on Urbanise, I think doesn't mean that another building at the other end of the street is likely to want to use Urbanise. So it's not clear to me that it's going to be one of the great network businesses. But once it's got customers on its platform, they're probably going to stay for a long time, which gives it pricing power. So it's got some prospect there.
Okay, so watching to see. Tim, would you be buying this one?
Look, it's not something that, or it's not the style of thing that we normally take interest in. Property businesses or REITs tend not to have the sort of the growth potential and the value potential that we aim for. What I would say in its favour, it's retail property, which is, I guess, the most strategic type of REIT asset, given that there is the ability to add value through development, and there is something that property owners can do through thoughtful combination of tenants and lease structures. But probably also worth mentioning that the REITs have been one of the direct beneficiaries of low interest rates, given that their pricing is pretty much directly set by reference to bond rates, and in a very, very low interest rate environment, the prices of REITs do very well. If we, in the foreseeable future, see some normalisation of interest rates and bond rates, then these sorts of assets will probably come under a fair bit of pressure. So just be aware that when you buy something like this, you are implicitly taking a bet on low interest rates for an extended period of time.
Okay, so and would you be taking that bet? I mean, it's got a yield of 6.3%. It's a pretty attractive yield.
That is an attractive yield, and that's an argument that you hear a lot with respect to Telstra and with respect to the banks and with respect to bank hybrids. And every time we look at that argument, we don't think it holds water. We think that it's too many people are chasing yield, and anything that looks like it offers good yield relative to interest rates, typically when you analyse it, it doesn't represent good value, because so many people have piled in to try and get that yield that the price has been driven up beyond what might be justified.
The market. What do you think?
Yeah, look, I'm pretty useless in the context of this sort of question. We don't pay a lot of attention to the macro. We tend to be bottom-up stock pickers. We look for really, really good businesses that will thrive regardless of the economic conditions. Even if you can forecast the macroeconomic outlook reliably, there's plenty of evidence that says that doesn't usually translate into equity market returns. So we try not to spend too much time thinking about it. We obviously talk about it amongst ourselves, and it's fun to talk about, but our stock selection is all bottom up. We don't factor it into our process.
Okay. Let's put it another way then. Is there a particular sector that's a standout on the market that you seem to be having a lot of ideas pop up in?
Look, there are a couple of sectors that we do favour. Healthcare is one in particular where it's not hard to find businesses that have got a really, really strong market position and a long runway of growth, driven in part by ageing population. And the wealth and propensity to pay for healthcare that we expect that ageing population to demonstrate. Telecommunications is another area that we like. There's still, we think, a lot of room for growth once the NBN network upgrade is complete, we think that creates some interesting dynamics in that part of the market. So there are a couple of sectors that we do find opportunities in, but more broadly, we don't find much reason to be super confident about the Australian economy to the extent that that's relevant.
Okay, so Tim, looking at the gold space, some of the Aussie dollar gold miners have been doing very well, others haven't been doing so well. What are your thoughts on what differentiates performance in this space?
Well, yes, stepping back, gold is something we struggle with. We struggle with commodity producers generally because it's really hard to forecast commodity prices, and that makes it hard to have an accurate valuation. In the case of gold, it gets harder again because whereas with most commodities you can think about supply and demand and the cost curve and the uses for those commodities, gold it's completely emotional. The way it gets priced, there is the cost curve doesn't really matter for gold, if I can put it that way. It's viewed as a store of value and it's worth whatever people think it's worth. So for value investors like ourselves that want to work out the intrinsic value of a business and invest when we see that the price is trading below that intrinsic value, gold is really hard because we've just got no good way of working out the value of these businesses. What I would say in the case of Beadell Resources, it's not a business I know a lot about, but I can see from the numbers that it looks to be trading on something like 3 to 4 times forecast earnings. So you only need a 3 to 4 year mine life in order to get your money back, which suggests that this one is unusually good value for a gold business. If the price that's baked into those forecasts stays roughly where it is for 3 to 4 years, that's great. The issue with a lot of these businesses is that as a shareholder you don't often see that money because a gold business or a gold miner that has a short mine life has a pressing existential question, and what they do with that money is they pour it into whatever they can in terms of exploration or acquisition to extend the life of the business rather than returning all that money to shareholders. So not an area that we have much success in or much interest in, but Beadell, just as a passing comment, it does look like it's sunk pretty low, and if there's nothing hidden in the balance sheet that's not obvious to me at the moment, it may be a good one. As I say that, I notice that it has what looks to be quite a lot of debt on the balance sheet relative to its market cap. So there's a number of red flags that get raised there.
More about it.
Okay.
Tim's the expert in value. Maybe he can give us his 2 cents worth.
I mean, they've managed to refinance, but it hasn't really helped the share price. A little bit up in June and then all the way back down again. So what are your thoughts on this one?
Yeah, look, a long history of destroying shareholder value. It's in terms of the forecasts, broker consensus shows it earning $1.3 million in 15, $1.5 million in 16, and then $12.4 million in 2017. So profits up by a factor of 10. Sometimes businesses do that. Most of the time they don't. So it's certainly not one for us.
Okay.
Thanks, guys.
Sure. So having a look at Insurance Australia Group and REA. So Berkshire Hathaway buying a stake into Insurance Australia Group, and I guess you could call it the Buffett effect. The stock up 4.3% today.
Yeah, that's been taken as a good sign. Dylan, we're a little bit intrigued as to IAG. It's a stock that we have looked at in the past, and we haven't quite been persuaded as to its the right balance of quality and value. But we're intrigued to sort of dust off the analysis and see if we can work out what Buffett has seen that we might have missed. And we're a bit intrigued at his interest in the Australian market, given that Berkshire Hathaway needs to deploy really big chunks of capital to move the needle. And the Australian market, it seems to us, offers somewhat limited opportunities for them to do that. Having said that, IAG is a business that it's sort of for us it hovers in the grey zone between being expensive and average and perhaps being a bit more interesting. So it's one that we're going to study a bit more. REA is one that we own at the moment, and there's some interesting dynamics going on in respect of REA, where we're in a property market that is very hot, and counterintuitively that is probably not all that good for REA, because one of the reasons that the market seems to be hot is seems to be a somewhat limited supply. So there's not that many people wanting to sell at the moment, which is helping to support the prices, but it's keeping the number of listings down. The other thing that's happening is that properties are selling very quickly and easily, which is not necessarily good for REA, because what REA like is for a property to be advertised on REA and then advertised again because it hasn't sold in the time frame of the first ad. And when time on market comes down, that's actually not such a good thing for REA. So we saw slightly disappointing revenue growth rates at the last quarter, and the numbers suggest to us that nothing has changed in respect of that, and we may see a period of somewhat subdued growth for REA. But your question was about long-term value, and there we think the answer is yes. REA is a business that has a really phenomenal potential future earnings path, in that it has a lot of power in the property market. It has the ability to raise prices steadily for many years into the future. And if they do that the way we suspect they will, then the current price may look like pretty good value a few years down the track.
Okay, so
do you think Ramsay Health would be a good buy if it goes back down to $59, which seems to be where it got support last week? Thank you.
Sure. So let's start off with Capital Health. Up 85% over the past year. Would you still be buying it at these levels?
Look, Jenny, it's not one that we ever have been able to buy. It's an interesting business, but on our numbers, the valuation has never stacked up. And it certainly looks like at the moment the valuation continues to not stack up. It's got really good growth potential over the next few years, but even if that growth is delivered, it still looks to us to be expensive. So it's not something that is getting a lot of attention from us at the moment. Ramsay Healthcare, as you probably know, is a business that we like a lot and have owned for a long time in the Montgomery fund, and are very happy investors in it. Your question is, does it represent good value a little bit south of the current level? And there I would have to say it's not a screaming buy. It's a business that is of such good quality in our view, and has such good long-term prospects that it would be very hard to persuade us to sell it. But it started to become expensive recently, and the pullback that we've seen in the more recent period has brought it a bit closer to fair value, but it hasn't brought it to a level where we would be jumping in to add to our position. But if you've got a long-term view, it's a great business and it should do well.